Welcome everyone once again to our webinar. Our topic today is investing in trust deeds using your IRA or 401k. My name is Natalie with SenseFinancial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. We have assisted over 3,000 clients since 2010 and established more than 4,000 self-directed retirement plans. If you are not part of the SenseFinancial family, we would be happy to set you up with a complimentary consultation just to discuss how you can be in control of your retirement savings. If there are any questions during this presentation, feel free to type them up in the chat area. We will try our best to answer as many questions as we can after the presentation. But today, Jeff LaMotte and Dmitriy Fomichenko, they will be our presenters. Before Dmitriy starts the main presentation on how to invest using your IRA or 401k, I would like to briefly introduce Jeff with Val-Chris Investments. He will briefly talk about what he does and discover information on trust deeds investing. So Jeff began his experience in the financial services industry while attending University of California, Irvine. After he graduated, he started to work as an account executive at Val-Chris Investments. And he became one of the top producers and personally helped Val-Chris reach #1 on Scotsman Guide's top private lender list in California. He also became a licensed real estate agent in 2011 and a California licensed real estate broker in 2012. And after that, he got his NMLS license a few years later. And with over a decade of experience in loan origination and funding, he quickly learned the skills which are necessary to originate, underwrite, and place private loans in the most efficient ways possible. So thank you, Jeff, for joining us today. I will let you take over from here.
Great. Good morning, everybody, and thank you for joining us. As Natalie mentioned, I'm Jeff LaMotte, and I've had the pleasure with working with many of you for quite some time now. Part of our push this year is to start offering more video content for our investors. We understand that our market is constantly changing, and these videos will help you as the investor to hear from us on these changes. But with that, we also believe education is one of the most critical factors in making informed decisions. We receive calls almost daily with questions on navigating the different investment vehicles available to our investors that will allow them to purchase our notes. Well, most of the time, we're unable to answer these questions since they are typically reserved for your accountant, attorney, or third-party professionals. We thought it'd be beneficial for everyone to hear from a specialist to go through these different options. Every investor's situation is different. Some of you are looking for low loan-to-value first trust deeds where the rate really doesn't matter, while others like the higher CLTV junior liens with the highest possible rate. I say that because there is no one-size-fits-all investor. The same goes for how you take title when investing your capital. Dmitriy, who will be speaking shortly, is a longtime investor of Val-Chris and also happens to be a specialist and advisor for the different options you can use as an investor when buying notes from Val-Chris Investments. As someone not directly affiliated with Val-Chris, Dmitriy has the unique third-party perspective some of you want when determining which is the best route for you specifically. I'll start by briefly speaking about Val-Chris. Many of you have been working with myself and Chris for many years, so a lot of this information is not new to you. But we have grown quite a bit over the last couple of years, so many of you may be hearing this for the first time. After I speak, Dmitriy will take the floor and review the many options available. After the webinar, the video will be emailed to anyone who registered, whether they were here to attend or not. So with that, let's go ahead and get started. First things first. So Val-Chris, as many of you know, we've been around since 1975. We've always done private or hard money loans, and that's our specialty. We've never felt the need to kind of venture out and go into different areas. We believe that if you stick with what you're good at, then you'll be kind of the best in the market at that specific product. I also get a question, where do we get our business? So I figured I'd put this little slide together. The majority of our loans come from brokers. Some come from borrowers, but about 80% of our business comes from real estate brokers specifically for a variety of reasons. We can close on short sales, REO transactions, quick purchases, quick turnarounds. Our underwriting is done in-house, whether it's by me or Chris. Typically, it's done by Chris for a quick decision, and brokers, borrowers come to appreciate that. And it also adds consistency to the pricing since our industry is not a typical rate sheet type environment where it's easy to know. Having the same underwriter review each deal gets it done pretty quickly. Not to mention our experience between Chris, myself, and many others at the company, we have quite a bit of experience under our belt. All right, now you as the investor, why do investors choose us? I'm sure there's many different reasons. Everyone's got their own reason. And the big one, though, I would say is, again, since we've been in business since 1975, it's virtually unheard of in our industry. There's very few people or very few companies, I should say, that have been around for this long. We offer loan servicing in-house, which not many do. We have decades of combined experience, as I mentioned, with servicing specifically as well. Our volume is, I think, greater than a majority of companies in our space, considering the amount of loans that we're offering monthly. And not to mention the resources that we have for you as investors. You guys can contact us and we'll be happy to assist any way we possibly can. Benefits of servicing. I always like to go into these since we get asked quite a bit, what does servicing entail and how do we do it? We have a full-time staff of 4 people in our servicing department. So when you call us, we'll answer it and we'll do the best we can to assist you. We do everything from collecting and payments to all the stuff no one wants to do, and that's sending late notices, non-payment follow-up, dealing with the notice of defaults, foreclosures, and trustee sales as needed. We also handle tax service on terms that require it. We deal with the demands, and it's all kind of a one-stop shop. So we're not going to nickel and dime you for each service that is provided, and we believe that that is a benefit to our investors. Funding ability. So as you guys have seen, our volume is quite high for most private lenders. Right now, we're averaging between 75 and 90 loans per month as far as actual fundings. We got close to 100 a couple months ago, a few different times, but we're right just under that number is typically where we're at. We have the capacity to fund well more than that. If that number is under 100, it's because we've chosen not to fund certain loans just due to the quality and what other reasons. And we feel that due to our in-house servicing and due to our ability to fund a large amount of loans, we can be picky on what we're funding. So we're not funding every loan that comes through the door. Our capacity continues to grow. And with that growth, I think this education and other video type content will assist. Types of products we offer. So as you guys see, we do kind of everything under the sun, depending on what you're looking for. First, second, third trust deeds, all different property types. We'll do bridge loans, collateral, cross collateral loans, purchase loans, refinance, cash out, and rate and terms. There you go. Loan terms. Again, it's whatever you guys want to see, but typically you'll see loans anywhere from 30,000 up to 6 million. 1-3-year terms, typical prepays you see, and then loan to values. I put loan to values on here because they have dropped considerably over the last, I would say, 6 to 9 months. We've gotten more conservative in our underwriting when it comes to loan to values, just kind of watching the market to kind of see what goes on. But we feel that 65% is kind of that sweet spot right now as far as maxing things out for the most part. And still, given our terms, roughly the average payoff is about 18 months. So that's what you're going to see across the board for the most part. And a little recap for me before I pass it on to Dmitriy. But Val-Chris, we've been one of the longest and most trusted track records in the state when it comes to private money or hard money loans. We currently service well over 1,000 loans at any given time. We offer a wide variety of products to make sure that we're offering you as the investor the most possible. And we feel that our experience in ownership is a huge benefit for you as the investor. And we always try and make sure you guys know that you can contact us or email us, or you can come in and see us if you have any questions or need guidance whenever possible. So with that, I want to say thank you. That was my short little blurb, and I will send it over to Dmitriy and Natalie to take it from here.
Yeah, thank you, Jeff, for that. Before Dmitriy starts to present, I would also like to just briefly introduce him. So Dmitriy, he is the founder and the president of SenseFinancial LLC services. He began his career back in 2000 in financial planning and real estate investing. Today, he is a licensed California real estate broker, a real estate investor, and he's also a private lender. Over the years, he's taught hundreds of investment and financial planning seminars, and he's mentored over thousands of investors. So welcome, Dmitriy. I will hand everything over to you.
Thank you, Natalie, and thank you, Jeff, for organizing this, and glad to share this with you guys. Jeff, you can go ahead and turn off your camera now so we can just focus on the presentation. All right. So just quickly to share our mission statement is we are helping our clients obtain control and protect their retirement accounts. Proverbs 21:5 says that good planning and hard work leads to prosperity, and we want to come along your side to help you with that. And Val-Chris is a great company to help you with that. I personally been investing with Val-Chris probably 7 or 8 years now, done maybe 2 to 3 dozen loans with them, and it's been great. So I'd like to come just show you how you guys can also use your retirement accounts for that. Quickly, just to show you an example of what we do for our clients, the kind of IRA makeover. Jason is one of our earlier clients. He's found us online. He's based in Tallahassee, Florida. And before coming to us, he had a couple of different retirement accounts valued about $135,000, was watching the balances in his accounts go down. And so he contacted us. We were able to establish a self-directed solo 401k plan with checkbook control for him. And at the time, he was able to acquire 3 investments. He purchased a rental property, he invested in his brother's manufacturing business, and he purchased a note, just like Val-Chris offers. And combined, those assets were producing $1,000 a month for him at the time, about 10 years ago. Right now, his income probably more than doubled, and his assets probably tripled in value, at least. So that's what you can expect. Very quickly, a comparison between a conventional retirement account with the self-directed one. So if you do have a retirement account right now, it's held by the custodian, and custodian is the one who limits your investment choices. You can invest in stocks, bonds, and mutual funds. With the self-directed plan, on the other hand, you have virtually unlimited investment choices. You can invest in real estate, tax liens, tax deeds, options, mortgage notes, and trust deeds. You can invest in a private business and certain partnership. We do have clients who invested in real estate internationally in South America, in Canada, Japan, Europe, and so on and on and on. You can also do conventional stocks and mutual funds with the self-directed account. But there are basically 3 options available, and I'm going to explain those to you today. A self-directed IRA that is held by the custodian, a checkbook IRA, and also a self-directed solo 401k, which is known as the ultimate retirement plan. So let's jump into that. By the way, we do have a limited time today, so I'm going to kind of speed through my presentation. But if you do guys have questions, please put them in the chat area. Type your question, and we'll take some time at the end to answer hopefully as many questions as we can. So what is a self-directed IRA? Basically, it is a tax-deferred trust account that is held by the IRS-approved custodian, and it allows you to invest in non-traditional assets. This account's been around since 1974. The reason they're very little known because your stockbroker and financial advisor, number one, they might be ignorant of this option at all. Or if they're not, they'll discourage you because they don't want you to move their money away from them, because they make money regardless whether you're making money or not. They charge you fees based on the assets under management. And the bottom line is that no one is going to care more about your retirement accounts than you are. So the benefits of a self-directed IRA, it, number one, allows you to invest in non-traditional assets. It allows you to have true diversification, because if you're investing in the stock market, you're just in one asset class. You may be thinking that you're diversified because you invest in a mutual fund, which within the fund invest in possibly 100 different stocks, but you're still in one asset class. The returns on your investment are tax deferred. There is no capital gain tax on the sale of real estate if you buy real estate with it, or if you invest in a trust deed, all the income that you generate is sheltered from taxes. So how does it work? Well, step number one, you open a new IRS-approved custodian account with a custodian that allows non-traditional investments. Number two, you move the funds from your existing retirement account to the new one via direct rollover or transfer. So the funds are moved from your existing IRA, 401k, or 403b to the new account. Then at that time, you direct the custodian what you want to do. So you can buy a piece of real estate, you can invest in a note, all the income from those investments going back to your IRA, all of the expenses being paid from an IRA. The disadvantage of this option is that custodian is there to make money. So every time you do a transaction or every time you buy or sell an asset, there is a fee. Also, there are delays because you have to always go through a custodian, which is essentially middle man. You have lack of control. You have to deal with the red tape of the custodian. You have to evaluate the asset every year and pay fees, again, for making investment, for selling the investment, for paying investment-related fee, and also asset fees. So for this reason, some people choose to opt in for a checkbook IRA. What is it? Checkbook IRA is also known as a IRA owned LLC or IRA owned trust. This is when the special purpose LLC or special purpose trust is created. It is created with one single purpose to be owned by the IRA. It does require IRS compliant setup and operating agreement, but this structure allows you to bypass the custodian when making investments and transactions. So let's take a closer look at how it works. Step number one, again, you do need a IRS approved custodian to open the account for you. Then you move the funds the same way as in the previous example. But step number three, that's where it differs. A special purpose single member LLC is formed, or sometimes we utilize a trust, especially in California where LLC is cost prohibitive. We utilize a trust. This LLC or a trust is owned by the IRA and it is managed by you. Then as the LLC manager or as the trustee of the trust, you're able to open a bank account and IRA then buys 100% units of the LLC or the trust. And at that point, you can make investments without custodian's involvement. You can purchase a piece of real estate, you can invest in a trust deed, and all of the income going back to the checking account of the LLC or trust, and all of the expenses are being paid from the checking account that you control. Again, there is no middleman. This structure allows you to bypass the custodian and also eliminate the fees. So the advantages of the checkbook IRA, you get the checkbook control. So you're able to bypass the custodian. You have direct access to your funds without a middleman. You can have the transaction done in a speedy manner. You're not dependent on custodian anymore because you now can make the transaction as quickly as writing a check. LLC also gives you additional protection from litigation. It minimizes the cost because there is no transaction fees. And you hold the asset title in the name of the LLC or in the name of the trust, respectively. And then the next option will be a self-directed solo 401k plan. This is known as the ultimate retirement account, and you'll see why just over the next few slides. But what it is, solo 401k is established under Internal Revenue Code Section 401, subsection K. That's where the name comes from. And it is specifically designed for those people who are self-employed or own a small business and don't have full-time employees. It's not a new type of plan. It's essentially a traditional 401k plan that covers only the business owner and the spouse of the owner. This type of plan was made possible as a result of changes in the tax law in 2002. And those changes made the benefits that I'm going to explain in the next few slides possible. So let's take a look at eligibility next before we jump into the benefits. So to qualify for a solo 401k, you must meet two eligibility criteria. Number one, the presence of self-employment activity. And this activity can be in any shape or form. You can be a doctor, an attorney, a property manager. You can do some network marketing, on and on and on. If you generate some self-employment income that you report on a Schedule C, you're eligible. And then number two, absence of full-time employees. By law, if you do have full-time employees working for you more than 500 hours a year, then you are obligated to offer the 401k benefits to those employees as well. But since solo 401k is unable to incorporate employees other than the business owner and the spouse of the business owner, you will no longer be eligible for this. So it is not for everyone, but to those who qualify, the benefits are way superior compared to an IRA. So let's take a look at the absence of full-time employees. It's actually some of the employees can be excluded, such as leased employees, and also any employees that are under 21 years of age, and those that work less than 500 hours annually. So let's take a look at the structure of the solo 401k. How does it work? First, you have to have the sponsor of the 401k plan. You have to have the LLC, corporation, or just a sole proprietorship. Then the sponsor of the 401k adopts the plan, and the trust and the plan are created. The trust is used as the funding mechanism for the solo 401k. So the solo 401k trust holds assets of the plan. You are designated trustee of the 401k plan, and as a trustee, you have full control over the plan assets. So you're able to open a bank account at the bank of your choice or any other financial institution. And then you decide what to invest and how to invest. And you can, again, buy a piece of property. You can do a private loan, invest in a trust deed, and so on. All of the income from those investments flowing back to the trust bank account, and all of the expenses are paid from the trust bank account. And they're paid by simply you writing a check. So it's as simple as that. Now let's take a look at the benefits of the solo 401k, which is pretty mind-boggling. Every time I get to this point, I don't stop being amazed of this. So number one, it gives you the ability to make significant contributions every year, over $60,000 per participant. Now, the contributions to the solo 401k consist of two parts. That's why it's so high, because as an employee, you can make a contribution of $22,500 plus the catch-up of $7,500, making it $30,000 for those over 50. And then on top of that, the employer, your company, can also make additional contribution, and the combined limit is between $66,000 to $73,500, depending on your age. Proverbs 21 says, "The wise man saves for the future, but the foolish man spends wherever he gets." So if you're a wise man, this vehicle will enable you to be that wise man and to put not only put money away for the future, but you also get an immediate benefit because you're saving money on taxes. I mean, just think about this. As elective deferral, you can contribute $22,500 plus the catch-up of $7,500, and that can be up to 100% of your self-employed earnings. Now, note that this amount can actually be done either pre-tax or on the after-tax basis. Every plan that we establish comes with the Roth sub-account. So you have the ability to designate those contributions after tax. Think of it this way. Would you rather pay the taxes on the seed that you plant or on the harvest? And it certainly makes sense to pay the taxes on the smaller amount, and then for the investments to grow tax-free. So that's what the Roth enables you to do that. Then on top of that, the second component is the profit sharing component, which is up to 25% of your compensation. So combined limit, again, between $66,000 to $73,500. Think about this. What if you and your spouse are in business together and you doing well and you're able to maximize the contributions? Then together, jointly, you can contribute over $120,000, potentially over up to $140,000 in contribution. Think what it will do to your bottom line as far as the taxes are concerned. It will certainly push you to the lower tax bracket, so you're going to be paying in a lower tax bracket and significantly lower amount. So the savings can be just huge. Additionally, solo 401k allows you to take a participant loan. Just like if you had a 401k at your employer and you can take a loan from the 401k, solo 401k offers you the same ability. The loan is amortized over 5 years. It allows you to be paid back monthly or quarterly. The interest rate is set at prime plus 1 at the time of the loan application. It can be used for any purpose, anything. And essentially, it allows you to access up to $50,000 or 50% of the balance of your account without taxes and penalties. So it's like you creating your own bank. This is your own bank that you can tap into anytime for any reason. So it will then allow you to invest in a transaction that will be otherwise prohibited. And it's not available with an IRA. Unfortunately, you cannot borrow from an IRA. The loan is only available with the 401k. Next, let's spell out the Roth contribution. So unlike with the Roth IRA, where contributions to Roth are restricted based on your income. So if you're over a certain threshold, you may not be eligible to contribute. With the solo 401k, regardless of your income, you can still make a contribution up to $22,500 plus catch up of $7,500 if you're over 50, for a total of $30,000. Compare that with $7,500 with Roth IRA, significantly higher. Again, with the Roth 401k, all income and gains are going to be tax-free. Unqualified distributions, the contributions can be accessed at any time because you're actually already paid the taxes on that. So you can actually pull the contributions out anytime. And if you do have pre-tax money in your 401k, you can exercise Roth conversion and convert those funds to a Roth. It's very cost-effective plan and allows you to have the checkbook control. No custodian is required. You eliminate custodian fees forever. You eliminate the red tape and delays. You serve as the trustee and the plan administrator of the 401k. So you are in control. You can act equally. Again, it can be as quick as simply writing the check. So if you receive the mailer from Val-Chris and you like the certain investment there, you secure it, and tomorrow, literally, you can execute on that transaction and then just write the check or wire the funds from your account immediately. And I've done that, like I said, several dozen times with Val-Chris. They're easy to operate, no annual filing requirements unless your plan assets exceed $250,000, in which case there is a short form 5500 easy, which is required to file, and we help you with that. So it's pretty straightforward, very easy to maintain. The bottom line that the self-directed plans allow you to have a true diversification. The credit for this cartoon goes to my daughter when she was little. She drew this cartoon for me. A man holds the basket. The basket represents the stock market. And the bottom fell off and all the eggs are gone. And wife is saying, I thought that our investments were diversified. Well, guess what? If you are in just one asset class, you don't have the diversification. To achieve a true diversification, you do need to invest in various investment types, asset classes. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on earth. And I've been doing this long enough, and I've seen people during the 2007 stock market crash, and also just recently, a couple of years ago, during the pandemic, when pandemic hit, I've seen clients lose as much as 50% of their portfolio. And that can be devastating depending on your age. But guess what? My portfolio of trust deeds with Val-Chris has not been affected because they continue to pay. I had some that been delinquent, which eventually worked out, and it's significantly lower risk comparing to the stock market. And you have guaranteed return, which is a contractually guaranteed, and your investment is protected by the real property. The bottom line, it gives you unlimited investment options. You're not just limited to one or two investment classes. I've seen our clients invest in physical real estate. You can invest in syndications, just where you buy a portion as a limited partner of the certain investment that is large. You can invest in tax liens, tax deeds. You can buy precious metals in your 401k. You can invest in cryptocurrency. You can be the bank, and you can actually invest your money, being the lender, invest in trust deeds. So the options are virtually limitless. Now, speaking of the limitless, there are certain restrictions that IRS has. And IRS does not give you a list of approved investments, but IRS gives you certain restrictions, what you cannot do with your 401k. And that is described under Internal Revenue Code section 4975 under prohibited transaction rules. And it specifies that you cannot invest your IRA in collectibles, in life insurance contracts, and into S corporation. Now, if you have an S corporation, if you're an owner of the S corporation, or you want to set up a solo 401k, you can do that as long as you have no full-time employees. You just cannot use your IRA or 401k funds to invest into another S corporation, because you got to be a physical person to be part of the S corporation. In addition to that, the section specifies a disqualified person. And disqualified person essentially is immediate family member of the plan owner. So that's your spouse, your kids, grandkids, their spouses, your parents, grandparents. And also any entity in which disqualified person holds or has a controlling equity or management interest. So the extended family members, such as brother, sister, cousin, uncle, and so on, those are not considered disqualified, and your retirement account potentially can engage in a transaction with those extended family members. So let's take a look at the prohibited transactions. What are they? Well, it's a sale, exchange, or leasing of a property between a plan and a disqualified person. It's lending of money or extending a credit between a plan and a disqualified person. Providing goods, services, or facilities between a plan and a disqualified person. And I'll give some examples here shortly. Next, transfer to or use by or for the benefit of a disqualified person of the income or assets of the plan. Any act by a disqualified person who is a fiduciary where he deals with the income or assets of the plan for his own interest. And then finally, receiving any consideration for his own personal account by any disqualified person who's a fiduciary from any party dealing with the plan in connection with a transaction involving the income or assets of the plan. So just some of the examples here. We were talking about the engaging in transaction directly with disqualified person. That is where some common questions. Somebody owns a property and asking me, can I transfer that property to my IRA? Well, that's not possible because you cannot sell property to your retirement account. You cannot use your IRA as a security for a loan. You cannot guarantee the loan, so it has to be non-recourse financing if you buy an investment property. You cannot lend money from your IRA to a disqualified person. So that's not possible because that will violate the prohibited transaction rules. And any income that you receive from the investments that your IRA or 401k own must be for the benefit of an IRA. You cannot personally benefit that at this time. You certainly can benefit from your IRA or 401k in the future once you start taking distribution, but not while those assets are inside of your IRA. Also, any commingling between the funds or funds between an IRA and a plan personal accounts is not allowed. Now, let's take a look at just a quick comparison between those options. Okay, so all of them allow you to invest in non-traditional assets. You must have a custodian with an IRA. There is no custodian with a 401k. You must have a checkbook control. The checkbook control is not available with the custodial IRA, but you get checkbook control with the IRA LLC or IRA trust and with the solo 401k. There are transaction fees with the self-directed IRA for each transaction, but the checkbook IRA and solo 401k does allow you to have checkbook control and eliminate the transaction fees. With the IRA LLC, there is a cost for the LLC. So that's why in California, especially, IRA trust will be a preferred option. You can only borrow from a 401k. It's not possible to take a loan from an IRA. If you buy investment real estate and use leverage in an IRA, it will result in unrelated business income tax, but 401k is exempt from that. Now, take a look at the contributions. Again, the 401k contribution limit is 10 times higher compared to an IRA. So again, it's a great tax shelter. If you're in business for yourself or self-employed, not only you get to build that your nest egg for the future, but you get to benefit today because you're able to shelter a significant portion of your income from taxes. So you minimize your tax liability today. Solo 401k has a built-in Roth component, allowing you to have the Roth funds in parallel with the pre-tax funds. So it's just a separate sub-account within the 401k. And solo 401k is not for everyone. Self-employment is required for those that want to qualify and set up a solo 401k. So you must be self-employed, but anyone can qualify for an IRA. There is no requirements. Anybody can do it. So there is an option that will work for you if you have retirement funds and you want to expose them to be able to invest in alternative assets. There is a certain option that will fit you. But if you're invested in the stock market, then you might be feeling like the people riding this roller coaster. This reminds me of the stock market, and that's true. I think we all experienced that, or we've seen that. Well, those were my slides. Again, I had to run through them rather quickly because of the limited time today. But like Jeff mentioned in the very beginning, everyone's situation is different, and everyone has a unique situation. And I'm happy to extend this offer to you, a complimentary consultation. If you just go to SenseFinancial.com /consultation, that will take you to my calendar. You can see my availability in real time, and we can chat with you about your specific situations. I understand I cannot help everyone. This is not for everyone, but I'm happy to speak with everyone and help you with my experience. I've been practicing what I'm preaching. I've been utilizing a self-directed account for myself for many years now. In majority of that invested with Val-Chris, and happy to help you. Well, that will be end of my part. Natalie, do we have any questions there?
We have, I believe, one, but if there are any additional questions, please don't hesitate to ask us. We will love to give you an answer. We have a question from Vince. His IRA is in Vanguard, but he doesn't know if Vanguard is a self-directed IRA.
Well, Vanguard is not a self-directed IRA. Vanguard allows you to, self-direct. It's like, let me use this example for you guys. You understand the fish tank, right? If you have a little fish tank in your home, you have a fish, and that fish is free to swim anywhere within that tank. So that fish tank represents your Vanguard IRA. So with your Vanguard IRA, you can pick from several investment options that are available within Vanguard platform. But that's it. You have the boundaries. That glass restricts you from going elsewhere. And the self-directed IRA is like taking that fish tank and dumping that into an ocean. So you have, that's the comparison between the Vanguard IRA and a truly self-directed IRA, is a fish tank comparing with the ocean. So yeah, you cannot use your Vanguard IRA funds and invest in a trust deed with Val-Chris or any other investment. It's only what Vanguard offers. But you certainly can self-direct it, your Vanguard IRA. It can be moved to a truly self-directed account.
Okay, and then Abdullah did ask if we will get, if she will be getting a copy of this webinar. Just wanted to let you know that we will be sending a recording out to everyone who registered. But those are all of the questions, which brings our webinar to an end. Thank you everyone for joining us. If there are any additional questions that you have, please don't hesitate to contact us. We would love to give you an answer. And we would also be happy to set you up with a complimentary consultation with Dmitriy, just so he can answer any of your questions and to help you be in control of your retirement savings.
Yeah, looks like, Natalie, we had a question pop in from Kevin, who's asking if you can roll traditional IRA or 401k to a solo 401k. Yes. Solo 401k will accept rollover from any retirement plan with one exception. And that one exception is a Roth IRA. So Roth IRA is the only account that cannot go into 401k. Now, if it's an employer-sponsored plan such as 401k or 403b or 457, if it's with the past employer, you can freely move it. If it's with the current employer, they probably will have the restrictions, so you got to check with them. But yeah, past employer 401k or an IRA can be moved easily. No issues there.
Okay, great. So I think those were all the questions. Again, if there are additional questions, do not hesitate to reach out to us. Other than that, thank you for joining us and have a great day.
Jeff, any final comments?
No, just want to say thank you everybody for joining. I'm looking forward to any questions you guys might have. Dmitriy and Natalie, thank you very much for your expertise and everything. And I look forward to speaking with everyone soon.
Thank you, Jeff, and thank you everyone for joining us. Have a good day.